Welcome everyone to a practical guide to home upgrade financing part 1. My name is Chris Conan. I am policy manager for Efficiency First California. I will be your moderator this morning on behalf of Build It Green and PG&E, which are sponsoring today's webinar. And if I can, there we go. Okay, so I would like to start by welcoming our members of the Energy Upgrade California program, participating contractors who are providing whole house energy services to homeowners throughout the PG&E territory and the Bay Area through the Bay Area Regional Energy Network. Welcome today. We also have online contractors involved in PG&E's QC Quality Care Rebate program, which helps homeowners with heating and air conditioning services in their homes, again throughout the PG&E territory. And I want to welcome you to the webinar today. It's your hard work that is helping to move the state forward with achieving energy reduction goals and delivering comfort and indoor air quality to homeowners throughout the state. Today we have 3 presenters. First is Bruce Mast, Director of Business Development for Build It Green, and he will be giving us an overview of financing options in the market today, so that everyone on the call can see what types of products are available, and then in your conversations with customers, I'll be able to help them identify the type of financing product that would suit their situation. Next, we will have Erin McCollum from EGIA, who will be talking to us about their energy or GeoSmart loan program, which has a number of very interesting options for contractors. A lot of options to use with customers, again, so that you can find a custom fit to the financial needs of your customer and that specific product. And then finally, we will have Mark Tsimanis, who is Chief Lending Officer for the Matador Community Credit Union, and he will be talking to us about their energy efficiency, residential energy efficiency, and solar loan programs, which are statewide and also offer very attractive financing features for folks throughout the state. Okay, and now, before we dive into our presentations and information today, I just want to remind everyone on the call that you can submit questions through the questions pane on your control panel. We will take questions from you throughout the webinar, and then at the end we will have a Q&A session at which all 3 of our panelists will be available to answer questions and discuss points that are of interest to our attendees. So just remember, as we're going along, if you have a question, you can submit it to us as you are thinking of it and through the question pane. And we will then be gathering those for the Q&A session at the end. And so at this point, before I turn the reins over to our first presenter, Bruce Mast, we would like to conduct a poll question for those of you on the line, and we have the poll opening now. So if you would take a minute or so to respond to the poll, that would help us understand a bit more about how financing is working for you and your business, and that will help our panelists also understand a bit more about the needs that you, our valued attendees, have. So let's see here. And now I see that we have the majority of attendees on the call are using financing between 50 and 75% of the time on projects. So I think that indicates that this is clearly a very high value topic and something that is widely used. So thank you for responding to the poll. So we will close out the poll now, and let me move on. So our first presenter is Bruce Mast. He is Director of Business Development with Build It Green and has been involved with the organization since 2002. He has played a major role in developing the vision of the organization and growing the organization to a vital contributor to the statewide energy program and a valuable partner with government and utility partners. And Bruce has an extensive background in working with utilities, in market research, in business plan development, program design, and business evaluation services. So with that, I would like to hand over the webinar to Bruce. Welcome, Bruce, and thank you for being on the webinar today.
Thank you very much, Chris. Chris, I apologize for being late. For logistics here, should I tell you when to advance, or do I get to advance it myself? Advancing the slides.
Yes, if you would just say next slide, please, I will be happy to move the slides along.
Great, very good. Thanks, everybody. The poll results were very interesting. Hopefully I'm preaching to the choir. Go ahead and next slide. I wanted to start out by talking a little bit about just why financing is so important to your business. And so maybe I am preaching to the choir, and that's a good thing. Maybe the people who don't think financing is important aren't on the call. But I wanted to take a bit of time to really stress that just to motivate the rest of our session this morning. Next slide. So we'll start with the, here we go. And I want to thank my colleague Eric Howarth at the Electric Gas Industry Association. I'm going to show some slides that Eric and I have presented together a couple times now, once I think last year at the Contractors Forum, and they've done it at a previous webinar earlier last fall. And I just really want to stress that financing should be an integral part of your sales and marketing process. That this is a really important tool to have in your hip pocket. And you've got different kinds of customers that have different financial situations. You probably need a couple different financial tools given, to meet their different needs. But you want to make sure you've got something for everybody, and you don't want to assume that only a segment of your customers need or want financing. And so we'll talk a little bit about how financing can play into this, into your success here for different kinds of customers. Next slide. So one thing to stress is that even people who have the cash in their pocket may want and need financing. And so just the fact that you've got a bunch of cash in your pocket, it's still hard to write that big check, cash separation anxiety. So National Association of Home Builders and the Joint Center for Housing Studies at the University of Harvard did some research and found that 50% of home improvement projects over $5,000 of finance. So a very substantial number of projects do get financed, and of course the bigger the job, the more important the financing. Next slide. So I wanted to call out three kinds of customers that you might have, at least from the perspective of their financial needs. One is the cash buyers. They've got some liquidity, they've got some money in the bank, but that doesn't mean that they're prepared to sit down and write a check with lots of zeros behind it. And then you've got customers that they don't have the the cash on hand. They do have reasonable credit. They need to be able to spread those payments out. They're really concerned about the monthly payment, particularly if they are counting on some utility bill savings to help offset that and keep their monthly cash flow going. So they need low monthly payments. And then you've got people that don't have such great credit. And a few years ago, that was a big segment of the population. I think it's starting to get better, but that's still an important segment. And the good news is there's some new programs coming on board to help get a little bit deeper into that segment as well. But the point being that just about every customer that you have probably fits into one of these categories and could benefit from some kind of financing, even if they've got some money in the bank. Next slide. So let's, here's some numbers that, this is based on a survey of EGIA members. So these are illustrative. These are not necessarily, exactly what you could expect, but I wanted to illustrate how financing might play into your bottom line. So being able to offer financing does a couple things for you. For one thing is that it means that this is one more thing that you can advertise, that, hey, we offer financing. We have, attractive terms that can actually be part of your selling point, whether you're doing Google AdWords or got a Yellow Pages ad or whatever, or even if it's just your door hangers. You can, use financing as part of your marketing pitch and use that to attract, a couple more leads. So in this example, by being able to offer financing, you can go from 10 leads to 12. When you get into actually converting those leads into jobs, financing, you're going to have a couple jobs that would not be able to go forward if there weren't some kind of financing available. So you're going to be able to close a few more of those. And so in this example, that is moving from three jobs closed to 5 jobs closed. The other thing that it can do for you is you can increase your ticket size. So someone, especially a cash buyer that could afford a $9,000 job now with some financing, can move in and do $10,000, $11,000. So now you get larger average tickets. And so when you start to run the numbers, what you see is with the financing options, 5 tickets averaging $10,800, you've got $54,000 in revenue, which is twice the revenue if you're just doing cash only. You just got 3 tickets at $9,000 apiece. Right. So you go back to the number of leads that you started with, and you calculate that out, your revenue on a per lead basis, and you've got $4,500 net sales per leads compared to the 27 on the other side. So the cost of generating that lead and capturing that lead is only 13% of your total revenue if you're using finance versus 22% if you're using cash. So it's making your bottom line look better, and I think that's a really important thing to be clear. And you should be tracking this for yourself and monitoring, where your leads are coming from, how many you've got, what your close rates are, so that you can be, evaluating these numbers for yourself and confirming that you're getting these kinds of results. So if you're not set up to do that kind of financial analysis, I would encourage you to take our business and marketing trainings that we're offering, because we get into how to do this kind of business management, and this feeds right into that. Next slide. So I just really want to stress this point. Be methodical, and this is something you want to train your sales staff to do. They have a couple financing tools in their hip pocket, and offer that every time and make that a standard part of the conversation that you're having across the kitchen table, and not to assume that, oh, this customer doesn't need it, doesn't want it, and just make it a consistent part of your sales pitch. Next slide. So I want to talk about the kinds of financing tools that are out there and when they're applicable to different segments of your customers. And then I'll give you a brief overview of a couple financing tools that are out there. We're not going to go into in depth today, but anyway, let's just dig into it, and I'll show you what I want to talk about. The first thing I want to do is just talk about the kinds of financing and which customers benefit from those kinds of tools, and help you kind of think through which kinds of tools you need to have in your hip pocket, and under what circumstances would you offer one to another. So I want to call out 3 kinds of financing in particular, the unsecured, secured, and PACE financing. So unsecured financing means that you're not using your house, or you're not using some kind of big asset as collateral for that loan. So a typical example of that is your credit card. So if you don't pay your credit card, the credit card company is not going to come and repossess your home, right? There's I believe EGIA will talk a bit more about some of their unsecured products today through their GeoSmart program. So the key things there that drive this is the lender's looking at the personal credit of the borrower. So they're looking at that credit score, the FICO score. They're looking at how much debt they have, how much income they have, and making sure that if you add this additional debt on this, that this is still within kind of their kind of reasonable ability to repay. So they're looking at the personal credit history of the customer. So as you can imagine, good credit gives you ready access to unsecured financing. If you've got poor credit, then this may be closed off to you. So then you get into secured financing products. So I've got a few examples here. One's an energy efficient mortgage. Also, there's 203K, which is a home improvement loan. A lot of banks offer a home energy line of credit, HELOC, home energy line of credit. These are financing tools that are secured by the home itself. So they're still looking at the customers, the borrower's personal credit. They're looking at their FICO score. They're looking how much debt they're carrying, how much income. But they're also then looking, does the borrower have equity in the home that can be used to back up that loan, so that if they don't repay the loan, the lender has recourse to come and recover their loan by taking it out of the house. And then the third category I wanted to touch on is PACE, Property Assessed Clean Energy Financing. And some of you have been around for a while know that this was a big deal back in 2009, 2010, 2011. What this is it's not actually a loan, it's a lien. Subtle difference. It's a lien that a public agency like a local government places on a home to pay for public services in general. I'm speaking generically here. So for example, you might look on your property tax bill and see a line item for a landscape and lighting assessment district, right? So that's a lien that's on your property tax bill that is used to pay for sidewalks and street lights and public improvements like that. So this is a particular kind of lien that allows the local government to place a lien on the property, give that money in cash to the homeowner, and then the homeowner is paying that back twice a year on their property tax bills. Right? Examples of this is the Sonoma County Sonoma County Energy I program. Boy, drawing a blank here. There's also the Home Energy Retrofit, the HERO program down out of Riverside County, and then there's a program called California First that has been on home. There's been a lot of politics around PACE at the national level that has been holding this up, but there's some reason to believe that this might actually start moving forward later this year. The key thing to know about this from a customer eligibility perspective is that these programs require some equity in the home so that this lien doesn't put them underwater and create risk that the mortgage holders are going to lose their money. But because it's tied to the property, the local government, it's not credit-based, right? So they're not looking at the personal credit of the owner of that home. They're looking at the equity of the home. So much more flexible eligibility terms in that sense. All right, next, let's go to the next slide. So when would you want to use one versus the other? So unsecured, it's good for smaller projects. The benefit of those is that it's a quick approval. You can often, if you've got kind of a relationship with a bank or a lender already in place, you can often qualify your customer right across the kitchen table. They fill out a document, you can type it in, you can log onto their website, bam, you can qualify them right there on the spot. You don't have to go and get an appraisal of the home. You don't have to put up any home equity. So very quick, very easy. The flip side of that is generally these are going to be shorter term loans, so 5 years, 10 years instead of the 15, 20, 30-year loans. You're generally going to pay a higher interest rate because the lender is taking a little bit more risk. They don't have that property to secure it. So when you combine shorter term and higher interest rate, you're going to have a little bit higher monthly payment. You will also see some tools here that are pretty attractive. For example, there will be some unsecured loans that have like no payments for 12 months or zero interest for 12 months. Those are really good, for example, with your cash buyers that want to get the project started. They don't necessarily want to write that big check up front. They can take out this loan, get the work done, pay the contractors, and then 12 months later they can pay this loan off before the balloon payments start kicking in, and they can kind of manage their cash flow that way. It's also really great. You can use some of those loans with deferred initial payments. For example, if you just want to bridge between doing the work, paying the contractor, and getting a rebate or an incentive. So there are some really good unsecured loans that are very appropriate even for your cash buyers who have some money. So you want to make sure that you've got some kind of unsecured products in your toolkit. The secured loan products, great for larger projects. You can borrow more money. It's because it's being backed by the equity in the home. You can borrow more at one time. If you're doing something like an energy-efficient mortgage, you can actually bundle it right into the mortgage. So it's really good when you're like combining home improvement with a home purchase. Buying a fixer-upper. Really good for that. So because it's got the equity of the home backing it up, it lowers the lender's risk. They're willing to lend for a longer term, willing to lend at a lower interest rate, and so when you combine those factors together, you get a lower payment. So if your borrower is cash flow constrained, they want to try and get their monthly payments down below their utility bill savings, this is probably a better option for them to do that. The flip side of that is that the qualifying time and the paperwork is more extensive. So you've got to actually demonstrate the home equity, show that they've got good credit, and they've got a home that's worth something. You may or may not have to get an appraisal. That varies. And I have to apologize. My computer just went having technical difficulties on this end. Bear with me. My computer thinks that I've been inactive, and so my power saver mode kicked in. All right, I'm back with you. So, anyway, that's longer, more elaborate process, I guess, is the point around the secured loans. Then with PACE, it's a lien, which has the benefit of not kind of digging into the personal credit issues, so it's much more appropriate for someone who is credit challenged. They do have to have home equity. The challenge here is that it's not available yet in a lot of our markets in California. It is available today in Sonoma County. It is available today in communities in Riverside and a few Southern California communities. And I'm hearing some feedback that there's some changes politically, both at the national and state level, that are making PACE more viable statewide, and that we can expect to see some PACE programs coming forward probably this summer would be my guess. I'm not going to get into the details of what's going on with PACE unless someone asks, but it looks to me like it's coming. Next slide. I've got just a quick rundown of different kinds of financing products that are out there. A couple of the other speakers today will talk about some of these, but I just want to give you some examples. So, secured loans include energy-efficient mortgage. Those are available statewide, although you'll need to find a lender, and I'll point you to a HUD website where you can find lenders. Same thing with these 203Ks. I'll talk a little bit more about those first two, what those mean. So that's also you can find it through HUD. I believe EGIA can tell you about their GeoSmart loans. They have an unsecured product as well as some secured products. FHA, Title I, Power Saver, those are both secured, and those are available statewide. There's some loans that are publicly backed through the California Alternative Energy and Advanced Transportation Finance Authority. This is a state agency under the state treasurer's office. They've got some funding that uses public funds to reduce the risk to the lender, so they can get some more attractive financing terms and products that are available to lower credit scores. The exact terms depend on the lender, so we've got the representative from Matador today, I think, who can talk about what they're doing, and that's available statewide. CHF, I think there's going to be a future webinar that's going to dig into the opportunities of the CHF. This has also got public funding behind it. It's available in 44 counties. That pretty much covers all the urbanized counties in California, so chances are where you work is qualified for a CHF loan. I've talked a bit about PACE. Right now it's available in 2 counties. It's expanding through California First and the HERO program, and like I say, by this summer, I expect that a lot of California will have access to that. And then at the bottom, I listed other, and these are the borrower-initiated type financing where you go and you use your credit card, you get a home energy line of credit, home well, the point I want to make about these others is I would encourage you not to just rely on your customers to go find their own financing. You want to have a solution in your hip pocket. So that's what I want to do today. So next slide. I want to say a little bit about energy efficient mortgages because this is, I think, the only time we'll talk about this in this two-part series on financing. So the deal with energy efficient mortgage, it's a federal program. It's backed by FHA. There's also a VA version, but most of the energy efficient mortgages are through FHA. It's for single-family homes up to 1 to 4 units. The borrower meets all the standard requirements of FHA, so it doesn't differ from any of the other FHA loan requirements. You can get a 15-year mortgage or a 30-year mortgage. So it works just like a mortgage. The difference is that you can calculate the expected energy savings and calculate the improvement in their cash flow and borrow that extra amount without requiring additional equity in the home to do it. And there's some formulas for how much you can borrow. So it's limited to the cost of improvements or 5% of the property value, whichever is lower, and that's actually a bit of a simplification as well. The detailed rules are a little bit more complicated, but at a kind of a first rule of thumb, cost of improvements of 5% will generally get you in the ballpark. And then the borrower's down payment requirements are fairly modest, 3.5%. So fairly accessible program, like I say, really great if you're dealing with someone who's buying their home and they want to do some home improvements at the same time and incorporate energy efficiency improvements into that. Good product for that. You can also use it if you're refinancing your home, but there you have to go through, basically treat it like a mortgage. Next slide. So the 203K mortgage, it's also a mortgage. It's also backed by FHA. The deal with this is that it's a home improvement loan. And eligibility, again, 1 to 4 unit single families, has to be owner occupied in this case. There are credit score requirements, debt to income. What's important about a 203K is that it's not narrowly limited to energy efficiency, so you can do any kind of home improvements except for structural improvements. You can't do structural, but any range of home improvements that you need to do. You can also bundle a 203K with an energy efficient mortgage. This is really good if your customer is buying a home, they want to do a home improvement project as part of that, so they can use the energy efficient mortgage to fund part of the energy efficiency, and they can use the 203K either to do more energy efficiency or to maybe do some of the other stuff that needs to be done as part of that. So one example would be, hey, I want to put solar panels on my roof, but to do that, it's an old home with roof framing that no longer meets code, so I have to go in and do a bunch of retrofitting, and build and put in, stronger rafters and strong backs, things like that. So you could fund some of these other improvements that are needed to make these solar feasible. You can pay for that out of your 203K. Those kinds of things to make that project go forward. So it can be bundled pretty neatly. Cap at $35,000, but you can do a lot of home improvement for $35K. Next slide. I've talked on a number of things. Like I say, we're going to get into some of these in a little bit more detail in the rest of this session and in the next financing webinar, but I've got some websites here that you can go to figure out how to actually get the details, figure out how to get plugged in and have this in your hip pocket when you sit down across that kitchen table. So got some websites here for the key financing. 203Ks, energy efficient mortgages, you can go to the HUD website, you can do a little search on those terms and you'll get a big directory listing. There are a few sources that are better than others, and I was trying to get my information updated, so I had current information for you, and I don't have that yet. But if maybe when I follow up, we can send out some follow-up information about some of the more active local sources for those kinds of loans. Next slide. Thank you very much.
Thank you, Bruce. That was a great overview, and clearly there are many options, and this is a field with that contractors would benefit from understanding the resources they can bring to their customers. I think that was an excellent overview of what's available, and it gets us off to a very good start in our two-part webinar. Right now I'd like to take a couple minutes for our second poll question, and this is how important is it to provide information about or even to help with financing options in order to close a home upgrade sale? We'd like to know your experience and how much the financing resource is adding value to your own project sales experience. So we'll give that a couple minutes or a couple of more seconds here. Okay, and let's see what we've got. Okay, so moderately to very important taking a slight edge there. I think that we have the right audience online today for the webinar, and I appreciate your participation in the poll. So now I would like to move on to our next presenter, and that is Erin McCollum from EGIA, Electric and Gas Industries Association. Erin is Director of Programs and Trade Ally Program Manager, and she is very involved in assuring the delivery of quality services to EGIA members and coordinating deliverables and services through the Trade Ally Network. And Erin, before she came to EGIA, was also a program director at the Affordable Comfort Institute, where she was directly involved in many of the education programs that they had there and working with program implementers and other market partners. So very experienced in all of this. And now I would like to hand the webinar over to Erin so she can fill us in on the GeoSmart program through EGIA. Welcome, Erin.
Thank you, Chris, and thank all of you for taking time out of your day to talk about this important topic of finance programs in retrofit with energy efficiency. Next slide. So for those of you that aren't familiar with us, EGIA, we are a nonprofit trade association. Our membership is made of contractors, private contractors, those that participate in utility programs or statewide programs, such as Energy Upgrade California, as well as ones that are just active with their distributors and manufacturers. So this kind of gives you a breakdown of who we are. A lot of us we're out of the West, so most of our members are on the West Coast, but we have been engaged in providing contractors services to build their business since the 90s. Next slide. So as part of our membership benefits, our most popular one are our financing resources. We work with about 10 to 12 lenders at a time. We vet them. We do our research so that our contractors don't have to. We want to make it easier. It can be very confusing with the options that are out there, the lenders that are out there. So we work with our contractors, such as you, one-on-one to find the best program that's going to work for your business. We're going to get you enrolled as easy as possible. We're here Monday through Friday to take any calls, do any training that's necessary for your team, and we provide you with sales and marketing tools. Next slide. So let's talk about some of our programs. The Installment Plus Loan Program. It is an unsecured financing program. They are in what is called in the industry installment loans. Now this program is one of our most popular. It's a paperless application process. So you're going to be able to close those sales at the kitchen table. You're going to call a sales rep, put your customer on the phone. Within 5 to 7 minutes, you're going to get an approval. This program lends up to $55,000, so it gives you an opportunity to put those more expensive, your best options, your good, better, best options on this platform. They have fixed rates. They have no interest, no payment, equal payments. So the good thing about this program is there are a lot of plans available to you. That can also be a bad thing about this program. It gets a little overwhelming, but we'll work with our contractors to pick which ones you should be focusing on and help you out with that. Another great thing about this program is that for those of you that may be in a solar or geothermal realm, you can put tax credits and incentives on no interest, no payment, and then put the remainder of that project on a fixed rate for your customers. Next slide. Revolving credit. This is something that many of us are kind of familiar with. It is a credit card type program. So it has been around forever. You're probably used to it for some of your customers or you that use Home Depot or something like that. It's a line of credit that's provided to your homeowner, and they can use it on the current project that they have with you, or you can always go back to them and sell them on other jobs or offer other services because they're going to have a rotating line of credit available to them. It's mostly popular with HVAC contractors, other mechanical contractors that offer ongoing services. The lines of credit are a little bit less than the installment loan, but they have the same kind of options that are available as if it were any type of loan product. So you'll have your fixed rates, you'll have your no interest, no payment, equal payments, and the process is the same for you as a contractor selling it. You can put your customer on the phone at the kitchen table. You can go online. If you have an iPad, handheld computer, fill out that application. You're going to get an approval, and you'll be on your way. Next slide. The Flex Loan. The Flex Loan, this is one of our, as we call it, more flexible loan products. It has a lot going on with it. There's an FHA component to it, a Title I component, as well as unsecured components. Contractors that use this program are home performance contractors, solar contractors, ones that have those really large jobs and need greater options for their customers. So it's going to lend up to about $45,000. Same thing, they have no interest and no payment options. They have a 12 and an 18-month no interest, no pay. So if you wanted to put those tax credits and incentives for your homeowners on that no interest, no pay and put the rest on a fixed rate, you can do that on this program. One of the things that just came out recently within the past 6 months, they are actually offering a 15-year unsecured product, and the interest rate on that's about 6.99%, and that's been very popular with homeowners for our contractors that are on this program. Now you'll see that there's second look options. If you see there in those bullet points, this program has been used as a second look as well. The reason for that is, one, they do have that FHA Title I. They will take credit challenge customers. So you're looking at the first two programs we've kind of talked about is traditionally what people call A-paper borrowers. These will take ones with a little bit squirrelier credit. I've seen approvals on this around the 600 FICO mark. They do have a program that's a 580 FICO score. The downfall of that is on that program that will only lend up to about $7,500. So it's for those smaller jobs. HVAC contractors use it for mechanical replacements in service. But on your FHA Title I, there's no appraisal needed. They will take people that have had bankruptcies and open collections. Because it is a secured feature, there's a little bit more paperwork involved, but the loan officers with that program will work with you and the homeowner to get all those signatures and all of that stuff that's needed. Next slide. This is our Express Loan program. It is what we recommend to anyone that's just brand new with financing. But we've had people that have been on this program for 20 years. It's kind of our staple here. Offers the same options. You're going to get no interest, no payment. They've added fixed rates that will go down to 2.99%. They've just offered, and it is the same kind of process. It's in the home close, just a couple signatures, but it's just your basic. If you're just looking for a basic program that you want to use, this is what I always tell people. It's, you don't have to worry about that FHA paperwork or revolving lines of credit. It's just, the nuts and bolts, good key finance program to have in your back pocket. Next slide. Commercial. We also have commercial financing. Now, this is actual finance. It's not necessarily a lease product, which you've heard of. The interest rates are competitive. However, because the interest rates are based on the borrower's credit and all that good stuff, we can't actually quote them to you, but we do have a concierge that will work with your commercial customers to get you the rates and that sort of thing. It lends from about $5,000 to $5 million, and you're going to get up to a 5-year financing program, and they're going to own it, so it's not going to be a lease or anything like that. And I know that all of these programs, when you're being hit with them, seem very overwhelming. We're here to help at EGIA to help get you through it. I just want you all to take with you, there's no silver bullet to closing a job and building better margins. With finance, it's all about kind of silver buckshot. So we want to be able to put enough tools in your arsenal that help you close those jobs, help you sell more, and not be kind of bogged down with everything that's in there. Next slide. Then the other thing that we do offer is all of our plans. We have marketing materials. We have brochures. We have online buttons you can put on your website, online applications, logos. So for whichever program or programs you sign up for, we are here to support you. We provide sales training. We provide just even training on the actual finance program for your sales staff or techs that you may have out in the field, to people taking the incoming calls. So we do offer that kind of ongoing support for you as well, so you're not out there just, hey, we signed you up for financing, and you're kind of out there hanging. Next slide. So to sign up, just visit egia.org. You're going to see that Get Started Now button that's showing on the screen now. We just want you to fill out a brief questionnaire. That way we can serve you better. We will have a consultant give you a call and say, oh, I noticed that you checked off you want to offer flexible payments, fees are important, or what have you, where you rank, and we will come up with some solutions, and we'll talk to you about them and get a better feeling of what's best for you, and then we will get you enrolled in what is needed. So even if you have any questions for us just even after this webinar, feel free to call the number that you see there at the bottom of the screen. And of course, if you have any questions as we go along, I know we'll be getting those towards the end of our presentation here. But next slide. And here's my contact information. So if you do have those questions, feel free to give me a call or one of our very capable folks in contractor services. They are here to help you. And this is just a snippet of what we offer. I mean, we've got some exciting new programs on the horizon that are coming out. We're always modifying and adding and just trying to develop a resource for contractors and helping you fund those jobs. And that is all that I have.
Thank you, Erin. That was really a fantastic overview of a very rich program that EGIA has for contractors. Clearly, it offers a lot of flexibility and options depending on your company or your target market, and a lot of good support services. And I thank you for filling us in today. I'd like to now post our final poll question for the webinar, which is who on your staff is tasked with educating the customer about financing options? Is it the company owner, a sales representative, a financing incentive admin specialist, or other staff person? So we'll take another 10 seconds or so for folks to weigh in on who is leading this discussion with customers in their company, and take a look at our results. Okay, so let's see what we've got. Okay, so sales representatives are clearly the lead in this discussion, with company owners coming in a solid second there. Then that lets us know who needs to access this information in your organizations, and thank you for participating in the poll. So now I would like to move on to our third presenter today. Mark Tsimanis is with the Matador Community Credit Union. He is the Chief Lending Officer there, and the credit union Mark has been in the industry for over 20 years in a number of different roles, and he has, in his time with Matadors, he has been involved in expanding the lending programs into emerging markets, including their energy efficiency and solar loan programs. And Mark has been a personal advocate for energy efficiency through a number of presentations that he has led with our major market partners, including the California Public Utilities Commission and the Governor's Office. And he has been an advocate and champion at Matadors for the lending for efficiency in solar and the development of a clean energy market. So I would like to turn the presentation over to Mark to let us know about the energy efficiency and solar loan programs that they have available to contractors as well. So welcome, Mark.
Thank you, Chris. Next slide. So I'm very excited to be a part of this presentation and tell you about our unique program, which, as you'll see, is somewhat of a mix between an unsecured and a secured loan, a bit of the best of both worlds through the CATFA program, which I know Bruce has already briefly touched on. We are the only statewide lender for that program and have been and will continue to be the only statewide lender. So we're going to cover a little bit about Matadors, some details about the program and its activity and the process involved, and also touch on some other programs that we offer. So next slide. So a bit about us. We've been in business 50 years as of 2013. We've been in the EE space for, I want to say, 4 years overall, and credit unions have had a lot of good press and are very and a very easy thing to talk about at the kitchen table. That certainly has helped our business as a nonprofit. And many of you are familiar with credit unions, that nonprofits are able to deliver better rates and service oftentimes. And so that's what we do. Our name is a bit unique, Matadors. It comes from our foundation with Cal State University Northridge, whose sports teams are the Matadors. So just a little aside. And we have expanded greatly in the 50 years that we've been in business. We are now statewide in every lending channel, and as a matter of fact, in some channels we're in multi-states, and up to, I think, 10 states now. So very progressive credit union. Next slide. Like I mentioned, the specific program that we're going to be discussing is the one through CATFA, which does allow us to add some unique components to this program, which I'll touch on briefly. For example, there are no fees involved in this program because CATFA is able to give us additional federal funds. There are no fees to the borrower, no fees to the dealer, which is unique. Also, there's no risk-based pricing in our program. So whether somebody has a 660 FICO score or an 800 FICO score, they get the same rate. So that's another very advantageous component of the program, which comes from that partnership. Next slide. So historically, we began in our EE, our energy efficiency lending programs in 2011 through the Energy Upgrade California in the Los Angeles County program. We were the only lender there, and had expanded it in the end of that year through the CAFA program statewide, like I mentioned. And just mid-last year, the program was simplified to add efficiency, reduce paperwork, and increase ease of use. I make specific mention of, in the last bullet, to allow for the dealer to do both the pre and the post energy audit, which is a required component of this program. Next slide, please. Our suite of terms and rates are very simple. We have 3 options, 5, 10, and 15-year terms with the corresponding rates. Again, there are no fees associated with any of these for the dealer or the customer, and they aren't risk-based. Also, we do record a UCC lien on the property, which is a benefit to the customer because in most cases they can deduct the interest on the loan program, and it's a benefit to us, of course, because of some risk mitigation. If they were to sell the home, we get paid off, for example. Finance amounts range up to $50,000. Energy efficiency and solar projects are allowed, and we look for the advanced path, the EUC whole home incentive program, to be used. Solar projects must be interconnected before funding. So one component of this program is that the project must be fully installed to fund. There is a minimum FICO score of 660 and a maximum DTI of 50%. We're a portfolio lender, and also, as Bruce mentioned, these guidelines are set internally, so we do have flexibility to make exceptions, and we do make exceptions. Next slide, please. So a little bit about the performance of the program. To date, we've done close to $7 million in fundings. We have a very low decline rate, 25%. That's one of the lowest that we have out of all of the channels that we offer, all of the lending channels that we offer here at Matadors. Yeah, decline reasons pretty spread out, varied, but really, again, a very low decline rate. Okay, next slide, please. Next slide, please. Thank you. So there are very few steps in the program to get from application to funding. Once you scope the program and get the contract signed by the customer, you or the customer could submit the application online. Now, unlike an unsecured loan, you don't get an instant decision. There is a 1 business day turn time for decisions, but that is certainly much faster than a secured loan. So then we see this hybrid of the two. You would then have the contract. You would then apply for the utility incentive. Once the install is complete in step 3, then we issue the docs electronically to the borrower. They sign, send them back, and we fund the project. The only proof that we have that is mandatory in this program that the contract is complete is we count on the borrower stating that it is. So it's a relatively simple program. Go ahead and advance. Okay, so that was the statewide energy program. We'll now talk briefly about a couple of other options that are also mentioned. We have a very competitive home equity line of credit for those bigger projects. Rates as low as $3.99, a 10-year interest-only payment option. And the best case scenario, we're looking at 2 weeks from application to funding. And really the only delay is the customer. With the home equity, you do not need to start the project to have that happen. It's done independently of the project. And then if you could advance one more time for me. The last program that I want to talk about here that is statewide, except for San Diego County, this program is statewide, is our solar-only program with rates as low as $2.99. This is our fastest growing program. It does have a dealer fee involved depending upon the term and rate that you choose. No equity is required. We do record a UCC lien, and we have terms up to 20 years. And we have instant online decisions available. We do have other programs that are specific to Southern California, and those you could find on our website, matadors.org. If you could advance. And here's my contact information. If you have any questions, please don't hesitate to call me and email me. I'd love to hear from you. Thank you.
Thank you, Mark. I think we have a great situation here in the marketplace that we have so many good choices that offer different types of benefits, so there's a lot of flexibility for homeowners as well as for our contractors in delivering the right type of financing product for their customer. And today I want to thank Mark and Erin and Bruce for giving us some insight into this rich library of resources that we have. And now we are ready to start our question and answer period, and all of our panelists are available to take questions and from you in the audience. So just a reminder, the way to submit a question is to use the question pane on your control panel, which should be in the upper right-hand corner of your screen. And if you would let me know if you have a question for a specific panelist or if it's a general question, that would be great. And I see that we have some questions coming in, so why don't we get started and let's see here. Okay, here is a question. I think it's something that we could pose to the entire panel. It is, how can I discover if a homeowner has poor or bad credit early on so I don't waste time selling a job that won't proceed?
This is Mark with Matadors. There's a couple of ways. One, of course, is you could ask, and maybe half the time borrowers have a pretty good indication of what their credit is. And you could also ask specific questions in terms of bankruptcy and lates. And then there's also more commonly used soft credit hit companies that allow you to, for a fee, pre-screen your customers.
Great. That sounds like a wonderful way to pre-qualify your customer before you spend time developing a relationship with them only to find it might not go forward. Any other comments from Bruce or Erin on the topic of working with or identifying a customer with bad credit?
No,
Okay.
I mean, just to reiterate what Mark was saying, that most people, I mean, know they're kind of on the edge. So I know some of our contractors have had experience with just kind of saying, you know, the guidelines are around this and getting a gauge around that. But really, it's just kind of asking, and as Mark mentioned, there are the soft credit pull services out there.
Great. Okay, so here is another question from the audience. Do any of the financing options allow the contractor to help the homeowner with the financing application process? It sounded like a couple of the options mentioned today do allow that. Is it possible to provide a little more detail as to which ones allow a contractor to, say, prepare the application on behalf of the customer, or to take some of the financing application process off the table of the customer?
Yes, this is Erin. All of the programs that we have with GeoSmart are based around the contractor really sitting down with the homeowner, calling it in, or doing it online with them. We feel that not only is it best to close the job easier, we know that a lot of kind of jobs, once the contractor leaves and puts it in the hand of the homeowner, that job can just go away. So we allow on our programs that we have, the contractor is really in control of that process. When you get into more of the secured lending, the contractor's still in the process, but you're not in control, or you don't have to be involved in all of the paperwork for the secured lending. So you're going to be able to get the pre-approval with your homeowner, and then the loan officer will close that loan. So you'll know that you'll have that job going forward.
With Matadors, almost all of our applications are entered by the contractors, and also on the back end, the contractors aren't generally involved in the actual file paperwork. So it's, again, a hybrid. You do have the control up front with the application.
Great. Bruce? Yeah, go ahead, Bruce.
I would say, just as a general rule of thumb, you know, try to equip all of your sales reps with really good understanding of, you know, 2 or 3 financing products that fill these different needs for your clients. So depending on what they need, you can bring out the unsecured product or the secured, you know, et cetera, and make sure they understand in some detail how these products work. And if there's a paper application, they've got application forms actually in their hip pocket, and that at a minimum they can provide the customer with, you know, direction and, you know, help them work through the application. And in some cases, maybe your sales rep can actually fill it out, and it's just the borrower that's signing. But, you know, I guess my point being to really try to minimize the need for your customer to go figure it out on their own. You really want to be there helping them handhold through the process.
Thank you. That sounds like very good best practices. I have a question here about the mortgage financing. Bruce, I think this is for you. And that is, how much uptake is there for mortgage financing, either for time of sale or refi? It seems like it's a complicated process. Is that a significant share of the financing field, or more of a specialty item?
It has been a small niche product for various reasons. Some having to do with kind of the world of, you know, housing and finance, and, you know, then you had the economic crisis. You know, there's a number of reasons why that has not been a lot of uptake to date. FHA is going to be providing some clear guidelines to lenders that hopefully will cut through some of the confusion on the lender side. And I think the challenge, if you want to have that in your hip pocket, I think focusing specifically on energy efficient mortgage, I think the solution is to find a good lender who has experience originating those kinds of loans and understands what it takes to do that. And then you also want to partner with a HERS rater who has experience doing the HERS reports that you need to complete an energy efficient mortgage. And having that team in place before you sit down across the kitchen table, I think then gives you the assurance that you can help your customer through that kind of financing product. And there are a few that specialize in this kind of funding. There's a lender down in Southern California. Their website, I think, is gogreenlending.org, and they specialize in energy efficient and green lending and energy efficient mortgages and 203Ks and that kind of thing. Wells Fargo does some energy efficient mortgages, although they interpret the FHA rules fairly conservatively. So there are some issues there. So I'm hoping to be able to follow up with maybe with in a future email or newsletter article with some more guidance on which lenders on the list actually have more specific experience.
Yes, I believe that is a specialty in the lender arena, and you want someone with some experience to facilitate that mortgage process.
And Chris, if I could just have one follow-up.
Sure.
If you're looking at something like a 203K loan, I can tell you the guy's name who's done probably most of the 203Ks in California. His name is Kevin Nunn. He used to be with Comstock Mortgage. He's now with Umpqua Bank, and Umpqua has branches throughout Northern California. But if you actually go to the Umpqua Bank website and look at their 203K products, his name comes up. And he has done a bunch of these, and he's the kind of person that you want to partner with and have that relationship established before you get into a sales situation.
Great. Erin, I have a question for you. Does the EGIA commercial loan program include multifamily projects?
Yes, it does include multifamily projects. So for your attached units or apartment complexes, the commercial program would be applicable.
Okay, great. And also another question for you, Erin. Do we have to be an EGIA member to use the GeoSmart program?
It is a member benefit for our members. I do know that we have partnerships with Build It Green, for example, and Energy Upgrade California and PG&E. We do run partner programs where just give us a call, and we may be working with a manufacturer distributor or someone that you work with on a regular basis that can give you a reduced or complimentary membership.
Great. Thank you very much. Okay. Yes, we have a request to repeat the name. I believe it was Kevin Nunn of Bruce. Could you repeat Kevin's contact or his name and business affiliation? The gentleman who's handling the 203K loans.
Kevin Nunn, N-U-N-N. The lender is Umpqua, U-M-P-Q-U-A, Umpqua Bank. Google the bank and that website will come up. And I can get more specific. Actually, hold on a second. His email is kevinnunn@umpquabank.com. I've got his business card sitting here on my desk. If you want to call him, his phone number is 916-563-1028.
Great, and we'll include that. I'll add a slide to our PDF slide deck that will be available on the Build It Green website after the webinar with that information as well. So it'll all be part of the package in the library, in the learning library. Mark, I have a question for you. I understand that a contractor needs to be in the EUC program to obtain financing from Matadors. Are there other rebate programs that participating contractors can be in order to have access to your financing?
Currently, we're exclusively EUC with our CAFA program. So our solar program, you can apply directly with us and we manage that, but the EUC manages the contractor approval process for us with CAFA and other programs.
Okay, and a follow-up question to that is, under the Matadors program, do solar projects have to be in the California Solar Initiative program, or can they be an independent project?
They could be an independent project, but for the solar-only program, absolutely yes, they can be independent, especially in light of CSI going away in the not-too-distant future. And for the energy efficiency program through CAFA, also, yes, it can be independent. However, it does need to be in conjunction with an EE project, an Energy Efficiency Advanced Path project.
Okay, great. Thank you very much. I have a question here from an audience member. Does anyone have a form for connecting HERS and BPI professionals with contractors? I think maybe I misread that. Does anyone have a forum for connecting HERS and BPI professionals with contractors? I'm interpreting that as how can contractors be connected with the rating and building analyst professionals that are needed in some cases to qualify for these loans?
I would have to ask Amy Belay about who's invited to events like our Contractors Exchange, but I believe the answer is yes, but I would need to confirm that. Just check to see who's on the invitation list.
Okay. Well, I think one thing we can do here is, as a follow-up to attendees on the call today, we can respond to that question with more specifics after the webinar. So we'll follow up with you, and thank you for submitting the question.
I mean, one thing I can say as a follow-up to that is that for Energy Upgrade California, all three of the categories that were mentioned there are eligible participants in Energy Upgrade California. You can participate as a HERS rater or as a contractor with BPI credentials, and so I would expect that representatives of both of those business models would be generally present at forums that are open for Energy Upgrade California.
Right, and this is probably a good time to mention that PG&E is hosting a contractor exchange on March 4th in San Ramon, and everyone on the call should be receiving announcements about this event because you are on the participating contractor distribution list. So you might want to take a look at the agenda for the upcoming contractor exchange and see if there are resources there that answer your question. So I have a new question here for Erin. Does the GeoSmart program have government partners, or is it a private sector financing program?
Currently, we don't have any government partners associated with us. Right now, we tend to have utility partners and then the manufacturer distributor side. But we have worked with government partners in the past, just not on any current programs.
Great, thank you. Okay. Let's see here. Oh, okay. Here's an interesting one. I think this is for the whole panel. How do I frame financing options as monthly payments like the solar industry does? How do your financing options help me provide a monthly payment quote?
This is Erin. On our programs, you'll get what's called a rate sheet. In those rate sheets, depending on the plan, there's an estimated payment factor. So you'd be able to multiply that factor by your loan amount and give your customer a payment. Of course, when it's a fixed rate, you can actually give them payment. But if you're running some interest-only promotion, it's just going to be an estimate. So an example, one of our programs has a payment factor of 1.25% on a fixed rate. So to make math easy, on a $10,000 loan, that person's payment would be $125 a month. But typically, that's how we're able to provide through some of our platforms the payment.
And I think that's standard. This is Mark over at Matador's. That's standard for most lending programs, including ours as well. They'll give you a payment factor that you could easily quote to the customer.
Great. Yeah, it seems the solar industry has been very successful framing financing on a monthly payment basis. So that's good that we have the same competitive tool in the energy efficiency arena. I have a comment from one of our attendees who says, please note that Sacramento County, Placer, and Yolo counties also have PACE programs. And that brings me to another question here having to do with how do, we're talking about state programs today, but we have an attendee that wanted to know how they would find out about local financing programs in addition to the statewide options that we're talking about today. Is that something that's available through Energy Upgrade California or some other platform or partner in this?
By local, are they asking about public financing programs?
It's not stated here, just maybe I'm thinking perhaps it's like the Sonoma County Energy Independence Program. It's a PACE program, but it's available just in Sonoma County.
Right, right. So, I mean, to the extent that we know about those, we can provide, links to websites and things like that. And there are some local financing programs that have been proposed for funding from the Public Utility Commission that are kind of getting caught up in a lot of the policy sausage making that I think haven't been rolled out yet. So we'd have to track down a little bit more detail about what's going on at the local level there. So yeah, at the local level, it gets a little bit more confusing. So I'm not sure I have a good answer for that.
Well, perhaps I can do a little research and we can follow up with our attendees today with a little more information on that one. Okay. Okay, I think this is a kind of general question for the entire panel. What is the state of the homeowner market in terms of debt-to-income ratios and being above water on mortgages? Has it improved at all?
In the Southern California area, Matadors has certainly seen an improvement. That's where the concentration of our real estate lending is, even though we have energy efficiency across the state. But yes, from our standpoint, it definitely has improved. Some of the improvements have been more in pockets, but overall there has been improvement in terms of loan to value. In terms of debt to income ratio, nothing has really changed in that arena, I think, for the last 4 to 5 years from our standpoint.
Any other comments on the general state of homeowner financial stability? Okay. I have a question for Erin. You mentioned tax credits in your presentation. Could you talk a little bit more about how that fits into the EGIA GeoSmart loan program and maybe give an example of how that might work on a given project?
Sure. Typically, I mean, as of right now, there's still tax credits for solar PV. So what some of our contractors will do, let's say the job is $40,000 and they're going to get $8,000 back from their tax credit. So a contractor will say, okay, for the $8,000, we're going to put that portion on a 12-month same as cash. So by the time you get your taxes done, the loan promo will be up and you can pay off that balance. And then for the remainder, we'll put on a fixed rate APR for 12 years, and that's going to give you a payment on your system for $125 a month or what have you. So that's typically how that works out. It's on those solar PV, I believe geothermal still giving some stuff. And of course the desired, I think it's desire.org engine will give you more information on what current incentives and rebate programs are out there that are available to you.
Great.
Chris, could I add a little something to that as well, even though that was directed to Erin?
Sure.
Just as another option with our solar program, we do allow up to 18 months for borrowers to apply any funds to the loan that they desire, whether it's from tax or otherwise, and we do a free payment reamortization for them. So they get the benefit of the lower payment, but they aren't mandated to pay down that same cash, just as another option. Sometimes borrowers have to take that tax credit over a number of years. Sometimes they don't get quite as much back as they thought. So one more option in that realm.
Great, thank you. Appreciate that. Okay, here we have a question. Do you have a financing product recommendation for products that start with an urgent need, such as replacing a broken furnace?
From our end, we have some of our unsecured programs do have a low minimum amount, so it could be something. Some contractors will use a revolving program where they can fix the system right away if it's that broken furnace, and then say, okay, noticing some other things on my assessment, you have a credit line of X amount of 30,000, we can do better insulation in your attic or things like that that can help you upsell, gets the immediate need done, and then you're able to upsell the customer.
Even though it's in the Southern California area, all of Southern California, Matadors has an HVAC specific program that has an intro, that has a rate currently that's at 2% with no fee for just that type of program. So it's a little bit outside, obviously, of the geographic that we're talking about, but I thought I'd mention that as well.
Great, thank you. So let's see here. Yes, here's a next question is, please describe what the timeline for payment to the contractor is on these various financing products. Does the money come to the homeowner and then to the contractor at project completion? I'm thinking out loud here. Are there partial payments that are possible through these loan options?
I guess it's yes, yes, and yes. For most of the stuff within the clearinghouse, it is within 24 to 48 hours of customer sign-off that the work's complete, the contractor will be funded directly. Some of the programs do allow a pre-funding that will allow you to fund, let's say, up to 20% for materials and costs, and then you can complete the job. You just have to complete the job within 30 days. So there are those options, but each lender has a little bit different of a process. Some of our lenders, it's completely paperless. They don't need to see a certificate of completion. Some want something signed off. Some it's just an e-signature from the homeowner or the contractor that the work is done. And then it's usually either funded through a wire transfer into a bank account or through a merchant service account.
And
that's typically how our programs work. Go ahead.
Sorry. And then for Matadors, just to go along with what was just said, For the energy efficiency loan through CATFA, the statewide, all of the funds are issued to the contractor upon completion. Again, that 24-hour, 1 business day period. For our solar program, all of the funds are funded prior to the job even starting and are given to the borrower in the form of checks to the contractor, and then they are simply handed over because many of those bigger solar jobs have multiple progress payments involved, and so we could fund up to 4 or 5 progress payments in those jobs, and those are all given to the contractor. I'm sorry, those are all given to the borrower to hand to the contractor.
Thank you. I think we have time for one last question. This is, you mentioned there are 3 types of customers: cash buyer, payment buyer, and credit challenged. What are good techniques for determining which one my customer is? Is it a matter of asking right questions, or are there best practices?
Usually, yeah, from our experience, the ones that are those credit challenged are usually pretty forthcoming in saying that they're, I don't think my FICO's that good, not really sure. I think the biggest missed opportunity for selling finance are those cash buyers that are just like, I have my own cash, and it's just a missed opportunity to sell. Because really it's that, as I know Bruce mentioned, Eric Howarth, he always talks about cash separation anxiety, and it's that, you just don't want to write that check over to the contractor right away. So it's the people, I think, the biggest opportunity is those that, are, comfortable, and they're just like, I have the cash, or I have a credit card. So I just think what you need to always incorporate is the finance sales pitch into everything you do. Just make that presumption that everyone should at least want to hear about it. And kind of get a feel that way. Sorry, is someone going to speak in?
Thank you, Erin.
Bruce, the one thing I might add to that is, I would put it in the context of what's called a consultative sales strategy, right? Going into the home and just approaching that sales visit from the mindset that, I'm going to help you, identify the problem, and, we're going to, solve this problem together, and approaching it from the perspective that really it's almost like, you're almost assuming that you're going to get the job, and the only question is what is the scope and how much is it going to cost and what is the problem we're going to solve, rather than, oh, I need to convince you that I'm the low-cost bidder, or assuming that, there's 3 other bids out there. And when you put it in that consultative sales strategy, then it's just a natural part of the conversation, and we'd have a whole webinar, a whole session around doing consultative sales, and hopefully we can touch on some of that at the Contractors Exchange and some of the other business and sales trainings that we have coming up with Mike Rogers. So I'm not prepared to say much more about it than that, but I guess I would urge you, if you're not using a consultative sales approach already, that you might want to investigate that and then think about how the financing message fits into that.
Great. Thank you, Bruce. And that's a perfect wrap-up for our webinar today. We're at time, and I want to thank everyone for joining us. Again, we will have a part 2 of this practical guide to home upgrade financing, where we will talk about the CHF loan program, more about PACE programs, and I'm thinking today that perhaps I'll ask Mr. Nunn if he might want to come on board and tell us about the mortgage options as well. We haven't set a date, but as soon as we do, you will be hearing about it through the Build It Green newsletters that you all receive as being participants in the EUC and the PG&E quality care programs. So I want to thank our panelists today for your time and your expertise and the great information, and everyone on the call for making the time to join us, and your great questions and your attention today. So with that, I will conclude the webinar, and we will see you at our next webinar in the near future. Thank you.